All right, hello and welcome to another for example video. Today we're going to be talking about ranges and how to see them on the live chart. So we of course know that when it comes to ranges are the ways that BFIs, aka banks and financial institutions, like to enter their positions into the market. They don't simply press buy and move the market up and down. They enter it by placing orders in a sideways delivery such that they can keep their orders discreet and hide it from those people who are trying to trade. Okay, so if BFIs, banks and financial institutions, were to place all of their orders at once, the market would just move up and down like this. You would just see that happening constantly. However, as opposed to doing that, what BFIs like to do is they like to stack their orders side to side in a range, right? And what this represents is a number of orders. So a number of small orders in a particular range before then initiating their price out of that range, coming back to mitigate and then continuing in the intended direction that they laid out by pushing it out of the market to begin with, okay? So what does this look like on an actual live chart? So before we jump into that, I just want to remind us all that we have three types of ranges that we're typically likely to see reactions from, okay? We have a doji candle, we have a full-bodied order block, and we have an FU wick. Now, doji candles are defined by having a body and then two wicks of relatively equal length either side. A full-bodied OB is a representation of many BFI orders stacked in one particular candle, all right? So that's where you get that full-bodied presence. It's showing that it's full of orders. And then FU wick, which is showing you speed and aggression. It has a small body and a large wick. And this can be, just so that we know, this can be turned upside down and it would be the same thing, all right? So now that we know that, let's look to the live chart to see what we can actually see and how this plays out in real life. Now, when we say that these are lower time frame ranges, what we are saying is that these single candles are representations of this same price action that we were talking about before. So on the higher time frame, let's take a full-bodied OB. This, let's say on the 5 minute, let's color this in. It's not really great coloring in. But let's say that this full-bodied OB, all right, is a 5 minute candle. So given that this is a 5 minute candle, if we were to go onto the 1 minute time frame or the 30-second time frame, what we are saying is that this is what it would look like, all right? We're saying that that OB, that full-bodied 5 minute OB on the order block, on the 30-second time frame or on a lower time frame than what this currently represents, is that price would look like this. And the reason why price would look like this is because there are more candles that are represented during the 30 seconds of 5 minutes than of one single 5 minute candle. Does that make sense? So let's get rid of that. So now that we know that, let's look at the live chart. So if I was to look at this, we are looking at GBP US dollar, all right? Now we have the top of our range here. We have the bottom of our range here. So you have what we call here a price range. So that is what is known as a price range. Now, if we were to go to this area right here, so we've got our premium and discount. What do we notice about this area before it shifts? So we have price come down to our low and then it moves up. Now, what happens before it shifts to come and break this low here? It creates a doji candle. Can you see that? Right where that cursor is here, there is a doji candle there. Now, what that doji candle is telling us is obviously that there is a lower time frame range going on. So that doji candle on a lower time frame, let's look at it. Let's see what it looks like on the 5 minute. So on the 5 minute time frame, that doji candle looks like that. All right. Do you see how we have this kind of sideways action going on here? Zoom in a bit more. Do you see how that one doji candle on the 5 minute, we have this sideways action, we have a bit of price moving up here, we have a bit of price moving down here, and then we've got some sideways movement happening here, all the way here. All of this sideways movement is a representation of that one doji candle. If we were to go on the lower time frame on the 30-second, it would look even more jagged, right? It would look even more sideways. So going back to the time frame we were on, I believe it was the 4 hour. If we look at that now and we see that that doji candle is represented there, that is an example of a range, of a lower time frame range. So when we come to that area, see how we've had a range, we've initiated by breaking this low. All right, this was a low here. We've broken this low. Break in structure. We've come back to mitigate out of that low, out of that range, and now we've pushed lower. Okay, so range, initiation, mitigation, continuation. But let's give another example as well. So whilst that this single candle is a representation of loads of different candles within that range, we can also see that price, anywhere where you see 3 candles gathered, there is a range present. Okay, so if I go down to, let's go down to the 1 minute chart. See if we can spot another range, because ranges are happening everywhere. Price is continually creating a range. Look here again. So we have this morning's price delivery. What do we have here? Let's zoom in so you can see it properly. Does that look like a doji candle to you? With the FU wick? That's to me. Notice in this gray area, we have, it is a doji candle because it's got a body and it's got wicks either side, this black candle here, but it's also got quite a large wick to the top. So that is an FU wick. FU wick equals lower time frame range. So we know that an FU wick is equal to a lower time frame range. So again, if we were to go on the, we're on the 1 minute chart right now, but if we were to go to the 5 second, this area would look like, in fact, let's do it. I can show you. All right, let's get rid of all of that. And let's see what this looks like on the 5 second. Right, do you see? Do you see how we have that sideways movement? So we've got from this high to this, from this low to this high to this low back again. That is a sideways move, okay? So on the 5 second, that 1 minute FU wick moves sideways. Do you see that? All right, so an FU wick is a lower time frame range in the same way that the previous doji candle that we looked at on the 4 hour moves sideways as well. Now, just to take that off so we can come back to where we were, as a principle, when ranges are created, when the BFIs create ranges, when they stack their orders in a sideways range, just like we saw on the 5 second here, when they stack it in a sideways range and then initiate price lower, they have sent out to the market 2 orders. They have sold a position to move down, but they've pushed price up and bought price to then sell it down. So they buy price, take out people who have sold here, all right, collect some money here, and then they sell that down. So whilst they're selling that down, they're in profit, but this buy order needs to be mitigated out of because it's in negative all the way until it becomes mitigated out of here. That's the whole point of a mitigation. The point of a mitigation is to mitigate and net zero out, AKA BE, break even, the buy order that they pushed up aggressively to then sell the market down. They buy upwards to psych people out of the market, to confuse people by people thinking that, oh my goodness, the market must be going up now. So they buy to sell down. And then whilst that sell order is in profit, Okay, they collect their profit to mitigate out of something here, they take profit, and then they push price back up to mitigate out that order to break even on that buy order that they initially sent so that they are not in loss. Now, once they've done that and they've mitigated that area, they can now continue to sell price down, all right? So they've closed out the buy order. They're now selling price even further down, all right? So again, that is range initiation, mitigation, continuation. But notice what they do when they mitigate. They create what here? Another range, all right? Price cannot move on thin air. There needs to be liquidity taken and liquidity to, there needs to be liquidity to take and liquidity, there needs to be liquidity to take and liquidity to target. So here, they've mitigated out of this order and they're now stacking again orders sideways. If we were to go on a higher time frame, let's go on a higher time frame and see what this range looks like, because a range is anywhere where you see 3 candles or more. Okay, and obviously we've got more than 3 candles here. So this is on the 1 minute time frame. What does this look like on the 5 minute time frame? Aha, what do we have? Look at that. Almost perfectly. We have a doji candle, all right, which shows us that on a higher time frame, perfect doji candle, body in the middle, 2 wicks on either side. And then what is that telling us? That is a lower time frame range. And we can see that by going to the lower time frame and seeing that indeed it is a lower time frame sideways move. It is a lower time frame range. All right, this is where they stack their orders discreetly so that we don't, well, traders who don't trade smart money concepts don't know which way to turn or which way they're going effectively, okay? So that being said, that is what range initiation, mitigation, continuation looks like on a live chart, okay? So you are looking for a series of candles that are bunched together in a sideways move, in a sideways notion. This is also a range anywhere where you see 3 candles or more. But then if we look on the higher time frame, this will be a range in itself, because look, we can see all of that sideways price delivery, price just bunched up together, stacking orders sideways to then initiate price higher, all right, and then do the same thing again, all right? So a range is anywhere where we are seeing candles being stacked together discreetly, which is a representation of banks and financial institutions stacking their orders to move the market. We'll look at one more example just before we wrap up this video. So if we look here again, all right, we're going to go on a higher time frame for this because so we can see. So can we see here that this range, all right, we've got a low here. This area right here is a range because we've got orders stacked. We could even really take this whole area, but we took that specific area because we were refining it, all right? But this area of sideways price delivery, this is price being stacked to then shoot up, which it does, yeah? So now once it's shot up, what does price do? It leaves liquidity. It leaves liquidity there to be taken to come back and mitigate, all right? So we can draw on that and look what happens once we mitigate. Comes back to mitigate out of this order. So just to explain it again, sideways range, initiation, right? We mitigate, and then we continue in the vein that this range was made for. So they've sold price down. You see how they've pushed price down? Let's zoom in so you can see it properly. All right. They sell price down to then push it up. And it's the same principle. That order that was sold is in negative all the way up here. Their buy order is in positive, but their sell order is in negative all the way until they come back and mitigate it out. Look, they mitigate right at the edge here where they sold down. Mitigate, and then they continue price moving higher. All right, so it's range, initiation, mitigation, continuation. Now, the best places to look for ranges, okay, is at the edges of the entire price range. So notice that we are at the edge of a price range here. We are at the edge of a price range here. Oh, let's move this along. We're at the edge of a price range here. Here, I'm expecting to see some sort of reaction. Edge of a price range, okay? Now, the reason why we take the edges is because we're more likely to bank higher R when we take the edges. If we are taking trades that are within the 50% area of a price range, so if we're taking trades randomly here, we're going to be waiting a long time because price likes to stack orders within the 50% to then move. If we stick to the edges, aka up here, yes, we're at the 50%, but the reason why we're taking this is because we've had that initiation to move upwards, all right? And then this creates what? Liquidity. Relatively equal highs. So we get liquidity here, which means that when we pull back into this area that created this move, we could potentially see this move and maneuver up here. And likewise, because we've mitigated out of this now, what do we have on this side? Liquidity, right? So we have money to take. So I say all of that to say, what price is doing is it's stacking orders within a range to create liquidity to both take and then to target. So they can take this liquidity up here and then target this liquidity down here at some point. We don't know when that's going to happen. That's why we trade daily, intraday, but the same principle remains: range, initiation, mitigation, continuation. So I hope that helps. I hope that makes sense. I hope that from this video, you've been able to take away some key learns. Just to review, we've looked at the 3 types of ranges that are available that we see represented in candle form. We have a doji candle, we have a full-bodied order block, and we have an FU wick. These are all representations of lower time frame ranges, which I hope you've been able to see in this video. And then also we factor in the fact that any candles that are bunched together, no matter what they look like, where there are 3 or more gathered, there is a lower time frame range, okay? Where 3 or more candles are gathered, there is a lower time frame range. So that's been me. If you have any questions, do feel free to hit me up in the Discord and we can flesh that out. But hopefully this has been a good explanation of ranges, and I will see you in the next video.